This is Trepp Wire Week in Review for week ending April 23rd. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, with 219 million vaccine doses now administered in the U.S., efforts have turned to everyone over the age of 16. In economic news, the jobs market recovery accelerated its pace, with once again initial claims hitting a new post-COVID low. And sales of existing home sales declined in March because of tight supply. And markets dropped after the news of Biden's capital gains tax proposal. Manus, what were some of your takeaways after this week?
Well, there was a lot going on this week. It was a big earnings announcement week. And I guess my posture at this point in the recovery, if you will, is that everybody now believes that this recovery is going to be extraordinarily robust, right? We saw some real nice bump in the stocks of cruise ship operators this week. We saw, I forget if it was United or American, come out and they said demand for the second half of the year is looking to be more than 100% of what it was pre-COVID. Even when bad news comes out, it's really shrugged off. So we saw Netflix came out with dismal forward-looking guidance and really poor subscriber additions in the quarter. They were expecting 6 million new subscribers in the most recent quarter. They came up with 4 million. In the next quarter, they had been predicting, or analysts had been expecting, 4 million new additions in Q2, and they lowered that to an expectation of just 1 million. And Netflix got clobbered. They were down 11% after hours, in the few hours after they announced the news. And the following day, they fell 8%. But the market shrugged that off. The NASDAQ was up sharply the day after. And what that tells me is that the market is a little bit priced for perfection right now, that everybody thinks that there are no bumps in the road. Mid-afternoon, we did see a bump in the road when Barron's and Bloomberg were reporting that Biden was looking to up the capital gains tax to either 39.6% or 43%, depending on which publication you listen to. That sent stocks sharply lower on that particular news. And it led me to think, what would the other things be that would really rattle investors in this otherwise incredibly bullish period? And I came up with 4 or 5 things, and take them for what they're worth. The first was that the Fed loses control on the inflation front. Obviously, we're seeing really big housing inflation, materials inflation. That would be one trigger for a sell-off. Another would be, and we've mentioned this one over and over again, if the Fed signals dramatically that it's going to end its bond buying program, I think that would send spreads demonstrably higher in the short term, as it did 6 or 7 years ago in the taper tantrum. I'm also keeping an eye on this Archegos stuff. Credit Suisse today announced it had raised $2 billion to improve its capital position. Morgan Stanley last week announced that it had lost $1 billion on the Archegos situation. These are transactions for which there's not a lot of transparency. If people start to feel like this is a little like ABX and derivative trading in 2007, if this is AIG 2.0, that would rattle the market. And I think if the corporate tax hike comes in on the high end of what people are thinking, Biden is proposing 28% up from 21%. If that ends up being the final number, I think any of those things could really take away some of this extraordinary bullishness that we're seeing right now.
Man, Dr. Doom today, Manus. I think that the inflation story is the one that's kind of most at the forefront of my mind. And, for all of us folks that were able to continue working from home, I think, our wages are probably the same or, increasing slightly or whatever they may be. But to draw the kind of real world economy, the workers that have to be there, to draw them back into the workforce, you're going to have to increase wages. And I think I saw that story on Wall Street Journal or somewhere else where, the largest trucking company in the US has increased their starting salaries by like 30 or 40% just to get enough people back into the labor force. So if you start to see those wages really tick up, that's when the inflation number actually, the CPI number, I think actually does increase. And that's when you might see those interest rates increasing, which is cap rates and everything else, right?
Joe calling me negative reminds me of a couple of things. We were owned by BlackRock years ago. I've mentioned that. And the person who headed us up, who acted as our CEO for several years, was the head of risk management. And he always wanted to hear the bad news first. I guess that's what you do if you're a risk manager. And I think that was ingrained in me at that point. So for all of our clients through Trepp Wire and other things we do, I try to lead with the things that can really tear people down, more as a risk management focus than my state of being. I don't like being negative in general, but it does remind me of that scene with Robert Duvall in The Godfather, and he's out in California visiting the director shortly before the horse's head scene. And he says, I have to get on a plane right now because Vito Corleone doesn't like to be delayed when there's bad news to report.
Yes.
So
Yes.
One of the great movies, one of the great scenes. That's not what I like to be. I don't like to be the bearer of bad news, but I do like our listeners to be prepared for anything. And those would be the 4 things that I listed before as things that would concern me and could possibly turn a really bullish market into something less bullish.
I call Martha our wartime consigliere.
There you go.
So let's look at loans that were delinquent last year and where they are this year. We had our own analyst, Catherine Liu, do some analysis to give us an idea of the health of this particular loan sector. What did we find out?
Well, what we tried to do, and Joe's going to go into some of the details, we knew that peak delinquency month was June 2020, and we asked Catherine to go through and document for us what happened to every loan that was delinquent as of that peak month. And she did some terrific analysis, and it does kind of underscore the bathtub filling up and draining at the same time. And as Joe will point out, it's some interesting numbers in there.
Yeah, so full report's coming out next week. You got to come to our website and find it, or you're probably already a Trepwire reader, so you'll get it in your email. So looking across the different property types, as of June 2020, we had about 16 billion in lodging loans that were newly delinquent. We had about 17 billion in retail. So, and then all the other numbers are low. I mean, industrial was negligible. Multifamily was actually near $1 billion. Office was about $1 billion. Those are probably like the standard levels of that weren't really COVID related. Now, today, the moral of the story is that almost none of this stuff is paid off or gone away with a loss, right? So when we say paid off, we mean either paid off in full or just liquidated and zero balance. So it's something like 1% of the lodging loans have gone away, and less than 1% of the retail loans have gone away from that pool. Now, it's about 50-50 on the lodging side in terms of what has quote unquote cured versus what is still delinquent. And I say cured with quotes because those cures may just represent forbearances. I think a lot of them do, where they're not being reported as delinquent and they're technically not delinquent, but there's still some funkiness going on. And on the retail side, the numbers are a little bit better. 59% are in that cured bucket and 40% are still delinquent. So, there's a lot of other numbers in here and you want to look at the report to get a better deal, but that's kind of the gist.
So a couple of footnotes to the report. The one thing we did look at was only loans that were 30 or 60 days delinquent. So we really tried to pare away things that were already troubled or defaulted prior to COVID. That was our starting point. As Joe pointed out, 50% of the lodging loans that were delinquent, give or take, are now not delinquent. But what has happened is that after June 2020, we saw a lot more loans go into the delinquency category. So even though half of the 16 billion has cured, that $16 billion number probably has gone up to 20 billion in total. And the outstanding amount of delinquent loans is still well above 8 billion. The fact that so much of this is still out there, for those of you that are looking for distressed, if you're worried that you've missed the boat, so to speak, that's not really the case. A lot of this stuff is still with a special servicer or delinquent, and the day of reckoning for a lot of these retail and hotel loans is still to come.
Turning to office, we've talked for several weeks now, probably months actually, about companies that are shrinking their office and headquarters footprints and having their employees work remotely or in a hybrid model. And until now, we really haven't talked about state or federal workers following suit, but it looks like we might have to.
Well, this started with a story that we put out this week talking about the state of Michigan and how it's looking to reduce its Lansing, Michigan office space. The state has 13,000 workers stretching over several million square feet. We did point out one property in that area where the state has already said it's going to reduce its square footage by 65,000 square feet. But the whole matter of this Michigan thing led to a conversation with Joe, Martha, and I about the risks involved in this particular part of the market. States and the U.S. government are huge consumers of space across the U.S. They tend to operate in places that are not really Class A. They're kind of more Class B. The government has usually been there for a long time. So if they choose to vacate, not only are they not in a great office, but they've also suffered from perhaps deferred maintenance for a long period of time. So if this becomes a real issue and governments start putting space back on the market or stop renewing leases or things of that nature, this would be an issue for many landlords. And what makes me think that this is a possibility is governments are, struggling, right, with revenue and so forth. And many will look to be cutting their budgets. And it's much easier to close an office, stop paying rent, and let people continue to work from home than it is laying off voters in your community. So this is something that it is possible, and it's something to watch. I think we looked the other day, I think there's upwards of $37 billion worth of loans that have a state or federal government as a tenant in some capacity. So it's a really significant number.
Yeah, this is something that I think I remember back in the day, years and years ago, we were doing queries on the GSA because there was some, I forget what it was. They were talking about reducing their footprint back in 2012. But in Trepp loan, we have kind of all the tenants normalized, and quote unquote government is the top office tenant, across the spectrum, bigger than, Amazon, WeWork, and everybody else. Now, government is a little bit of a broad term, so there might be some things falling in there that are not necessarily state and federal, but definitely worth keeping your eye out on. I think something you said there, Manis, is key, which is it's often not the Class A office building that these people are in, right? So if there is a downsize in any of these properties, it's, may not be the easiest thing to kind of re-tenant up that space without, significant updates, tenant improvements, and so on.
We have seen loans, big loans, that were GSA only type loans, right? 8 properties, all GSA spread across the US. Some of these were brought to market in 2007 and they did suffer losses, right? The government didn't renew, they put out an RFP, they moved to another location, and there wasn't a natural filler for what might have been 200,000 or 300,000 square feet, right? It's a big parcel off the beaten path and older space. I'll bring up a couple of other stories that are tangential to this particular matter. In Maryland, the Department of Human Services and Department of Health are going to look to move their offices to downtown Baltimore from State Center. In this particular case, this is a kind of a happier story, if you will. Lansing is looking to just give up space. In Maryland, what they're trying to do is use this opportunity to trade up to a part of the city that has been really hard hit by vacancies. In downtown Baltimore, T. Rowe Price and Bank of America have noted that they're moving out of that area. The area for a while has been struggling. It's kind of that area near the Inner Harbor and Camden Yards and so forth. And here is a governor saying, we're going to put an RFP and try to take some space right in the heart of this area that's struggling, which I think it's strategically wonderful. Anything the governor does to help that Inner Harbor area rebound, bring people back to Orioles games and the restaurants and so forth downtown is a good thing. So that's a positive story along the same lines. And one kind of more humorous line, we did see that one other government agency, or maybe we should say a higher body, is giving back space, and that would be the Vatican, who is looking to sell its high-end London office. I guess they too have seen a drop-off in revenue since the beginning of the pandemic.
A higher body.
Higher
Definitely.
authority, yes. So let's look at some of the office vacancies that continue to be a concern. There are a number of them.
Yeah, some of the stories we've talked about this week in Trepp Wire. One is in Lone Tree, Colorado. It was reported in recent watch list notes in April that Nationwide had vacated. Their lease ends in 2023, and they occupy 53% of the space in this Lone Tree City, Colorado office. In Philadelphia, Wells Fargo has vacated a 460,000 square foot office at 1 South Broad Street. Wells Fargo was the top tenant with almost 25% of the space. That particular office backs a CMBX 6 loan. You know, CMBX 6 is most noted for its exposure to malls, but here's a case where an office property could raise its ugly head as a problem down the road should this become an issue. The loan makes up 6.65% of a 2012 deal, so it's not an insignificant portion. Another one we're talking about is in Charlotte, North Carolina, Atrium Health, which was formerly known as the Charlotte Mecklenburg Hospital Authority. It is leaving its space at Whitehall 3. It has 26% of the square footage on a lease that ends in June. They were paying $20.50 per square foot, and that particular property that they are located in backs a 2020 deal. HSBC, their CEO, is calling for the ditching of posh executive offices and a downsizing of space across the globe. That was reported by Forbes. Under Armour in the Baltimore area will reduce its global headquarters by 40%. And the University of Phoenix put about 165,000 square feet up for sublet in the Phoenix area. That lease has another 10 years to run. So it's not a credit problem at this point, but it does put more space on the market in Arizona. This is a reminder for people that may have forgotten this particular matter, and that is that the administration prior to the Trump administration, so the Obama White House, was quite hostile to private college operators, for-profit colleges. So when I said before that the University of Phoenix putting this space on for sublet is not a credit issue, that's true. But what we saw in that period from 2008 to 2016 was a real clamping down on the practices of private colleges. And if the Biden administration follows that same playbook, that could become a credit issue. People may recall Corinthian Colleges basically was put into bankruptcy because the Obama administration had challenged their student loan lending practices and so forth. So while I'm not predicting this, it is something to keep an eye on, that sometimes the change of administration can impact certain industries differently than others, for sure.
It's funny because University of Phoenix always has those ads for online learning. So even the online learning colleges are affecting the real world brick and mortar space. So on the other side of the coin here, there was a story out of Bloomberg. Basically, the upshot is, despite uncertainty, investors are not shying away from bonds backed by offices. So far this year, there have been about $4 billion in CMBS tied to office towers in large city centers. One that was mentioned here was a Durst building, a refinance of 1133 6th Avenue and 114 West 47th Street, 1.1 billion there. Other bonds backed by marquee properties in Philly, Dallas, Houston, LA, and New York. Generally, the idea is investors in this are yield starved, and they're still making a bid for these assets.
Let's turn to positive office news.
We do have a couple of happy office stories that we wrote this week. One comes from Real Estate Weekly. The owners of the Stamford Plaza portfolio signed 2 new leases for almost 50,000 square feet. Why is this important? That's because occupancy at the 980,000 square foot complex was only 68%, and debt service coverage ratio from 2018 to 2020 was less than 1.0x. So a positive sign there for that property. They could use some good news. The loan is split among several 2014 deals, some of which are part of CMBX 8. And then in Texas at 600 East Las Colinas Boulevard, Fleet Pride has renewed its 47,000 square feet of office space at that property in Irving, Texas. Fleet Pride is a seller of truck and trailer parts. That particular deal that backs the loan involved as part of CMBX 7. So a couple of happy stories that we're always glad to report.
Last little parenthetical on the office before we moved on, because we've talked a lot about it, but there was a story, and just generally we've been talking about it for a long time. Maybe the upshot of a lot of this is that businesses or corporations are going to increase their profits because they're going to either downsize their space or they're going to keep their space and they're going to renegotiate and really, maybe chop a few percentage points off their operating expense budget and, pass that back to shareholders or to workers or to whatever it may be. So we have a very real estate centric view, we look at that as bad news, but it is a big cost savings. Maybe that money will flow elsewhere and boost the economy.
In retail, last year, we talked about 8,000 stores that reported closing. And this year, retailers have confirmed that about 1,000 stores are going to close. So is the apocalypse over at this point?
It's funny you should ask, Martha, because I was on the phone with a reporter earlier this week, and they were asking me the same thing. We might recall that we talked about UBS, I believe, UBS Research putting out a piece that said 80,000 more stores will close over the next 5 years. So 16,000 per year, which is a huge number. But I'm going to take a contrarian view, which I did take with this reporter. And that is, I think, just like Bill Clinton said, the era of big government is over. I think the era of huge store closing announcements is over. And I say this for two reasons. Number one is the store closing wave really started in 2015. The Sports Authority was one of the first ones. Later, we saw Toys R Us. The contagion spread to Macy's, JCPenney, Sears, of course, which is hundreds and hundreds of stores, Kmart, which is part of Sears. Dozens and dozens of corporate bankruptcies of operators of small inline stores, fashion, jewelry, footwear operators. So all of this started in 2015 with e-commerce picking up. There were waves and waves and waves of this pre-COVID. You get to COVID and you see a whole nother wave of bankruptcies, JCPenney last year going bankrupt and others, some more store closings. But when we look at our own portfolio of what we track, right, the tens of billions of loans we track, we're only seeing a trickle right now of things that are closing. And that's been the case for the last 6 months, right? You do see it here and there, a grocery store or a Dick's or something like that, where they close, often to move the store across the street. But my thesis is this, that if you survived the 5 years of e-commerce threat from 2015 to early 2020, and you kept your store operating between March 2020 and today, chances are you believe in this store and you're going to keep it going, right? You've pruned all that you're going to prune. And I think that we're going to see the numbers surprise on the downside for the next couple of years.
I've used this analogy several times, and then I remind myself that we probably have new listeners, so only the old listeners will be annoyed at me. But this is the Forrest Gump shrimp boat situation, right? Like, if you've made it through the storm with Lieutenant Dan on the top of the mast, you're going to be okay, right? Speaking of the tenant kind of normalization stuff, we went through it yesterday when we were talking about this particular topic, Manus. And the biggest tenants, at least in CMBS, on the retail side, a lot of them, like, it's no longer Sears, right? It's no longer, I mean, JCPenney's still kind of here, but they're not like number 2 or 3 like they used to be, right? Like, I'm just going to go through some of these on the list, and most of them Macy's is still there and they're kind of probably struggling a little bit, but It's Walgreens, it's Dick's, it's Home Depot, it's CVS, it's Walmart, it's BJ's. I mean, Kohl's. We can't go one episode without mentioning Kohl's. Dillard's, Target, Best Buy, TJ Maxx, Burlington Coat Factory. I mean, these are all retailers that have, done relatively well through this, or at least survived it. And it's snowing outside my window, which is unbelievable. Here we are, April 22nd, and it's snowing.
Going back to my retail point, just two more thoughts on that. One is that when JCPenney announced its bankruptcy, it said it was going to close about 250 stores. It's closed about 170, or it's in the process of closing some of those that are still remaining open. So it's only 80 more to go, which is a lot of stores, but they're 2/3 of the way done at this point. And my point before is that we're not going to not see store closings. They will continue to happen. But I think the days of, Bon-Ton over a really short period of time, filing for bankruptcy and then deciding to liquidate and shutting all the stores in short order, I feel like that time period is coming to an end. I think that we're going to surprise with a smaller number of store closings, certainly than what I saw UBS mention. And I think that, well below what we've seen over the last 5 years in average.
If you ranked all of the brick and mortar retailers, in terms of square footage, top to bottom, I'd love to see, I think it's probably a proxy for it is probably what I just went through, right? Some of these, but the ones that are still out there are, I think a lot of them are the ones that are doing okay, right? They're the lower cost, come here and get everything you ever need in one-stop shop type of deal.
Yeah, I think that even though there's a lot of distressed malls out there still waiting to be resolved, I do think that those malls have already lost 2 of their anchors. The Sears is already gone and the Macy's is already gone. Right. So maybe there's another store to go. Maybe there's a JCPenney to go, or a couple of other, stores still pending. But a lot of them have already seen the flight of those anchors, and accordingly, I do think that the worst is behind us.
Yeah, and I think we should differentiate. We're not necessarily saying that, the end. Or like we're on the upswing for malls. We're just saying that in terms of store closures overall, we're not going to see the crazy level of volume that we have. And I think that was a little nod to Dan McNamara, because I could hear him getting a little bit shaky with us touting the positives of retail right now.
Yeah, I agree. I think that we're not telling a happy story. We're just saying it may not be as bad as it has been the last couple of years. Right, in terms of velocity of store closings. Last week, we talked about maybe we had reached an inflection point. We rattled off between 5 and 10 transactions that took place in the previous week or two. Some acquisitions by Namdar, who's a buyer of distressed mall space. They normally continue to operate the property as a mall. Cohan was another one that we talked about. And we mentioned that it seemed like the logjam in the retail space was starting to come to an end, that there had been some price discovery during that time period. And we did see some more evidence of that this week. I'll rattle off a couple of stories that hit our radar over the last week. The first one in Florida, the shops at Sherbrooke, that was paid off. The collateral is a 58,000 square foot retail center that's anchored by an LA Fitness. The property sold for $11.3 million, which was well above the $7 million loan balance that is held in CMBS. The loan was supposed to mature last October. It had been in purgatory, delinquent off and on. And so why does this particular story matter? It matters because people were very bearish on gyms for a while. Everybody wanted to steer clear of them to see how COVID would play out. And now we have a transaction where a one-time distressed loan looks like it will be paid off in full, that has a gym as its primary tenant. I don't have the city where this was, but I should find that out. Another one, this is kind of similar. This was according to Real Estate Business Online. A property known as the Hagen Food and Pharmacy of West Lynn, Oregon, sold for $6 million. That's above what it was valued at in 2019. It was valued at 4.75 million. Why is this one important? Well, it used to be a Hagen Food and Pharmacy that occupied this. That tenant left. Hagen is a West Coast based operator. They may have filed for bankruptcy a couple of years. I don't remember, years ago. I don't recall. But the tenant was replaced by a mom and pop hardware store, and that's the sole tenant. And you would think that that would be something, even though it's hardware and people love hardware right now, you would think the mom and pop nature of this might lead people to be a little bit skittish. It's not a national tenant with deep pockets. And yet here we are in a situation where the property sold for $6 million and 1.25 million above the most recent valuation. So that was an interesting story for us. And then lastly, of the same ilk, in Mount Pleasant, PA, this comes from Trepp Live. The Countryside Plaza backs a $7 million CMBS loan. The top two tenants at the property had been County Market and Busy Beaver. They had made up 41% of the square footage. Both of those leases had been terminated in 2019. The property was sold for 8.5 million. So here you have another situation where a property is being sold for above the loan balance. Here the property is largely or almost 50% vacant, and yet a strong bid. So, 2 weeks in a row, we were seeing some real positive indications that people are dipping their toe into retail. And I think that that's a good sign.
I mean, maybe the play here is to put in like a franchise version of that $100 million deli from New Jersey.
There you go. 35,000 in revenue, 100 million in valuation.
That's
Yeah.
it.
Yeah, that seems legit. By the way, that Sherbrooke, the shops at Sherbrooke are in Lake Worth, Florida.
There we go.
Okay, turning to hotels. Remember a year ago when we were talking about hotels offering temporary housing for emergency and healthcare workers and possibly COVID infected patients? We were wondering if that would be a good idea. And at least one hotel owner has decided it was a bad idea.
There was an article in the Wall Street Journal, this New York hotel quarantined the sick. Now the owners regret it. The county paid this owner a bit more than $450,000 to take over their property for an 11-month period. And when the owner Mr. Patel, the owner came back and he found busted microwaves, refrigerators piled high in the dumpster, wear and tear on the room, like way more wear and tear than they had expected. Mr. Patel is grateful he didn't have to lose the property to foreclosure, but even with the revenue from the county, he's going to have trouble getting it back kind of into shape and up and running. So this is just one, data point, but not too surprising when you put people in that don't have a vested interest or that aren't actual owners, they have no incentive to treat your place very nicely. So too bad for this guy. I hope he figures it out. But
Well, there's probably, they say 15,000 hotels across the U.S. did similarly offer that service. So we won't know who actually took up the offer. And they
It would
probably
have been
don't
better
want us to know.
off hosting a rock band, right? Like Keith Moon throwing the television out the window.
That's right.
So we did have some positive hotel stories. I guess Joe called me the cynic, I guess, in the beginning, but I've had nothing but pretty good stories here of things that we're looking at in the hotel space. We did find this week that a specially serviced Georgia hotel in Albany, Georgia, basically paid off in full this month. It was a 122 key limited service hotel in Albany, Georgia, and the borrower paid back all but 13,000 of the loan balance and special servicing expenses. So 13 basis points worth of loss on a $10.5 million loan. Maybe 6 months ago, we would have been thinking 50% loss on this particular asset. It had been delinquent for 5 months leading up to its October 2020 balloon date. But here we go, another situation where a loan is paid off in full. In New York City, the Holiday Inn on 6th Avenue, this is in the Chelsea neighborhood, not far from Madison Square Garden and Penn Station. There's a $71.9 million loan on the hotel. The value of the property was $113 million 7 years ago. This month, the value was lowered to $78 million. So why is that important? You could see here that the value is still above the loan balance. There's still some positive equity for the borrower. When you have that situation, a much greater likelihood that this thing is not going to go the way of a discounted payoff or a foreclosure. That's a great story for us. And we saw the same thing with the Sheraton Lincoln Harbor Hotel in Weehawken, New Jersey. That one was valued at $128 million in 2015. In March, it was lowered to $87 million, which is still above the $80 million loan balance on the property. So there's still some positive equity there, although in that particular case, the special servicer is indicating that the borrower is still weighing whether or not to transfer title on that property and may cooperate in a friendly foreclosure.
Let me be the cynic for a second here and kind of go into, we're doing a lot of very specific stories this week, but there was one in Commercial Real Estate Direct, CREnews.com. They did actually a pretty deep dive into this one story about the Marriott Hanover Hotel. It's a 353 key hotel in Whippany, New Jersey. We had actually written about it in Trepwire, I think last month, when it went 30 days delinquent again. The story here is that they had gone delinquent last year. The mortgage was originated in 2019. It went delinquent in 2020. One of the reasons I want to talk about this is because it's owned by AVR Realty of Yonkers, New York, YO, represent. And we never talked about DMX last week, which is kind of sad. But anyway, they had acquired the property in 2019 for $85 million and put aside $15 million into a reserve account for a PIP program. They came out of their forbearance agreement 2 months ago. And since then, they have gone 30 and then 60 days delinquent. And this month, they're officially transferred back to the special servicer. So currently, the notes basically just say, recently transferred to the special servicer, attempting to reach out to the borrowers. The financials on this are a lot like the financials on a lot of lodging loans for 2020. In 19, they were at 74% occupancy, 6.8 million in NOI. In 2020, they were 23% occupancy, negative 1.7 million in NOI. So they haven't gotten an updated appraisal as far as I can see, but this kind of just jives a little bit with the first Catherine research piece we talked about, right? Which is the log jam is still there. All of these assets are still out there and outstanding, and there is going to be a need, or there is currently a need for capital in some form to come into this space, right? So in a property like this, I mean, I don't know anything specific about this property. Let's say in a story similar to this borrower is going to need to put up some more money to keep this thing afloat for the foreseeable future until occupancy comes back. So whether that's their money, whether it's a new JV partner, whether it's some sort of bridge loan that they get, right? Like there's all this type of need for capital out there. And I think that you said if the train left the station, or the train has not left the station, the train is delayed. That's kind of how I'm seeing it right now.
It is funny when we talked about trains being delayed, because the most frequent email I get every single day is from Metro North. And even though they're only carrying about 15% of, typical ridership, I would say that there's 15 emails a day I get from Metro North saying, the 648 to Ludlow is operating 15 to 20 minutes late. And I think, how is this possible when there's nobody riding the train, when you don't have to stop for more than 30 seconds to let people on or off? Are you constantly 15 to 20 minutes delayed? Two questions. How the heck and who the heck is on an email distribution list from Metro North? And second of all, you got to unsubscribe, dude. I think you just like getting angry when you see these emails. It's good fodder for you, so you like to stay on the email. Listen, stay off of my lawn.
get off my lawn. A lot of movie references today. All right.
At least 3. In multifamily, we had a lot of interest this past week in the occupancy analysis that was released. And there was a question as to whether that included student housing.
It did. The analysis that we referred to, and we've talked about it a few times over the last month, what we were looking for was pockets of weakness across the U.S. And by weakness, we meant properties that had less than 80% occupancy across the CMBS private label universe and Freddie Mac properties. What we found was tons and tons of cities with really no measurable number of loans in that category, and then pockets of real weakness like Long Island City and San Francisco, Boston, and so forth. They tended to be higher end, newly built properties that fell into this category. And if you haven't gotten that report, or if you're not on our blog distribution list, by all means, ping us. But to the question from our listener, it did include student loan analysis. I have to say, the student loan space was one of the biggest positive surprises of 2020. People were saying we're going to see 15, 20, 25% reduction in matriculation in August to September 2020. And while we did see a reduced number of students coming back, it did not result in any meaningful uptick in student loan delinquencies or defaults. There were some that were one-offs, but it wasn't the wave that really I thought that we would see. I thought a lot of places would default or go delinquent or request relief because of dwindling numbers, and we didn't see a whole lot of that.
Yeah, I don't really know what the story is there. You know, like if we had to ponder a guess, is it that the students went to these apartments?
I can tell you, I have.
But they still went on, like, you're paying for, well, there's also that idea of like, well, we got you, like we leased you the space for the whole year, and even though you're not using it, you still have to pay.
No, they were working online. And so if you were in a dormitory, you would have had to have gone off campus. If you were in an apartment, you could continue to go to class online and you could stay in your apartment for the period of the lease. So
it's almost contrarian, right? It's almost like there was more demand. There could have been, in certain cases, more demand for the student housing because the kids wanted to go to college.
Exactly.
And they're just sitting in their apartment instead of their dorm.
Well, there's also part of it that could be the fact that most people sign their leases for the year somewhere between 4 and 7 months prior to it taking place.
Right.
So at least with my kids, what I found was they were signing leases for the following school year in October and November. And it could be the kind of thing where the leases was signed, it was booked, and people just said, I don't want to fight this. I don't want to damage my credit rating, right? Or the kids just said, well, you've paid for it already. I could live at home or I could live there. Why don't I live there, right? That may be part of it. And if that's true, you may see a little bit of a delayed impact where people say, well, we're not going to make that mistake again this year. We're going to wait till the very last minute and see what's happening.
So we published this week the single family rental blog that did look at delinquency rates of single family rentals. And we've talked about that being a recession-proof segment. Does that hold up through COVID?
Yeah, so blogs up there by our good friend Max, looking at the SFR securitization space. I would call it recession resistant. I'll give a shout out to Fort Worth Chris, who has a very good podcast, and he had on somebody a couple of weeks ago, and I can't remember if it was Invitation Homes or I think it might have been Invitation Homes, the guy who started that, and talking about the single family rental business. Very interesting. And the idea here is that it's kind of, even in a recession, people may actually be drawn more to renting single family as opposed to buying. And that's, really happened in the last downturn, as all the big names really hoovered up a lot of these homes in foreclosure and then rented them out. The delinquency rates on these single family securitizations right now are very low. By balance, it's less than 1%. And by loan count, it's kind of around 3%, 3.5%. So we did see a little spike on that count metric back in May of 2020, similar to the CMBS space, but by balance, it's negligible at this point. So issuance, as far as the ones that we modeled last year, 8.3 billion in new issuance, which was actually a big increase from 2019. And this year so far, we're around 3 billion in issuance of these single family rental securitizations. So it's a very interesting space. It's not our, forte, but we definitely model all those deals, and interesting to see the growth of that market.
So Shoutouts, Luke R., Andrew J., Vincent D., Judd P., and Scott Berry. We have a couple of programming notes. One, the mid-year magazine that we publish in partnership with our sister company, Commercial Real Estate Direct. They do a great job of assessing how the year has gone so far. And if you are interested in learning about advertising in that or learning more about that, send us a podcast@trepp.com email. We also have a CRE Future Leaders Awards that is closing up. So if you know a college grad that's finishing up school in 2021, they can get the attention of prospective employers by sending us an application. And if they get selected, somebody somewhere will take notice, because we'll do a nice little dog and pony for them.
I used to aspire for things like that. Like I used to want to be one of those guys, 40 data analysts in the commercial real estate space in New York suburbs, marginal
40 under 40 CMBS data modelers who live on the Harlem line.
Now you got to do the
right with male that are with lower back pain, if they could meet that criteria, and now it keeps getting narrower and narrower. It's guys between 57 and 59 with falling arches and still lower back pain, and a big
the number keeps going
not
north.
So good at modeling anymore.
If I narrow down the funnel just quite enough, I might get to one of these lists one of these days.
I should say, all jokes aside, I should say that we are hiring a ton right now. Trepp is, and we have a bunch of interesting positions open, especially kind of in the product and development space. So check out our LinkedIn job openings.
Is one of them mine?
We can't say that. We're not permitted to say.
As long as you continue doing this podcast, we can hold you hostage for the rest of your life.
Gainfully employed. With that, we'll close, and thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or a comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.
All right.